What businesses can you acquire and not acquire using SBA financing? Hi, I'm Jaryd Krause. I'm the host of the Buying Online Business podcast, and today I'm speaking with Yankie Markowitz. I hope I'm pronouncing your name correctly. If I'm not, I do apologize. He's the CEO of SBA Loan Group. He's helped facilitate over $1 billion in SBA and real estate transactions with complex deal syndication. He's very, very sought out by bankers, and he helps intricate SBA transactions and structures because of his deep knowledge and unique experience in the US SBA loan programs. He's an executive board member for the Regional Business Assistance Corporation, and he's been on the loan committee, which allows him to work on hundreds of transactions for the SBA each year. He also serves as a board member for Crown Heights Young Entrepreneur and a nonprofit that is a full-service business resource center, specifically tailored to fit the unique needs for aspiring entrepreneurs that focus on promoting responsible business development and providing them with the tools and resources that they need in order to achieve that lifelong financial independence. And that's what we talk about in this pod, is how to buy these businesses so we can get that financial independence. In this pod, Yankie and I talk about the new changes to SBA loans, what it was before, what it is now, what's different, and how it can either hold you back or not really. We also talk about how much do you need to acquire, how much money, cash do you need to acquire an SBA loan. We'll also talk about what businesses work with SBA and what businesses don't. Typically, e-commerce businesses can work, and why a lower multiple works with SBA versus maybe not a higher multiple. And we talk about having your own lifestyle expenses and mixed with your debt service ratio as well, why that's pretty key. Yankie shares and explains a bunch of different acquisitions he's been through and how he used SBA and where SBA failed and what he did differently. And we talk about the difference between loan terms, the difference between seller notes, holdbacks, different deal structuring, what sort of business can apply for SBA versus not. If you want to buy a business using SBA, you just need to listen to this pod. It's so valuable. Yankie is such a great guy. He's got probably the most experience I know of anybody with SBA, been doing it for such a long period of time, and you'll see that through the pod. So enjoy. Before we dive in, we do talk about buying businesses. If you haven't got my due diligence framework, make sure you go away and get it. It's saved people millions of dollars and made people millions of dollars. It's what I use. It's what my clients use. It's for free. I'll put a link in the description for you. Yankie, thanks for coming on the podcast.
My pleasure, Jaryd. Thank you for having me.
I'm really excited to talk about SBA financing and the new changes, or I shouldn't say new, but there are some changes coming in as of after COVID, right? So we realize SBA has been around for a long time, and pre-COVID there were some conditions and things, restrictions, and then it sort of eased up throughout COVID, and then it sort of is coming back. And a lot of people listening to the pod are from America. They want to use an SBA loan to acquire a business. So what are some of the things that people should be aware of the changes from where it was to the update of now?
The main changes I would say are going to be, will apply to a select few in the crowd. But the main changes that recently happened is, one, it used to be that 50% of the injection that a buyer has to make into purchasing a business, and we'll talk about that in more detail later on, which is 10%, up to 50%, so 5% could be a seller's note. Now, that seller's note could still remain, but the seller would have to be on standby for the life of the loan, which is 10 years. I don't know about you, but I've never met a seller who's going to wait 10 years until they get paid money.
Absolutely not. Let's just give some figures there. For example, say somebody's buying a business, the deposit is $100,000 and they're buying $1 million business. So it's a 10% deposit. Previously, you could front $50,000 and then they will have a $50,000 note over the 10 years of the business. So
Correct.
People understand, right? And that's going to be a very, very hard sell for somebody that's selling their business. Like, put yourself in their shoes.
So for all intents and purposes, when somebody calls me up and they're buying a business, I tell them, look, this is a new rule, but for the most part, ignore it because you're never going to have a seller. I've never met a seller who's going to agree to those terms.
Yes.
Another thing that used to be possible was that if you were buying into a business, let's say you were buying 85% of the business, it used to be that the seller doesn't have to sign on the loan with you. Now that seller has to sign with you. So it begs the question, why does the seller need you? If they're qualified for, let's say, $1 million, why would I need you? I could just borrow the money myself and pay it out over time if I'm going to be a partner. And those, I'd say, are the main changes when it comes to buying business, particularly in that category, that people have to be aware of. The rest of it is minute stuff that doesn't really matter.
Okay. So the changes aren't too bad, really. I mean,
Well,
nothing to be.
the part of the seller's note being on standby for 10 years, I'd say, is very large. Go back a year ago, probably had 10 to 20 different deals that were able to get a seller's note because they only had to stand by for 2 years. And 5% on $1 million acquisition, $50,000 is something that could. And they say to themselves, you know what? I'll use that money later. At least I'll have some money coming to me in 2 years.
Yeah, and that's right. And they can sell the business and move on. Obviously, now if you have to do it, you're basically going to be buying from a desperate seller, a depreciating business, somebody that's willing to not take a portion of the business for 10 years.
I'd say the only time it really happens today, well, now going forward, is probably going to be a family member buying the business, or maybe a key employee that has developed a relationship with the owner for many years. I could see it working in that scenario.
Yeah, absolutely. And so is it 2 years or 3 years tax returns from the IRS that you need?
So I'll give you a little bit of background, a little more than just the 3 years tax returns. In the SBA world, they're always going to ask you for 3 years of tax returns, both personal and business. So they're going to look at your personal side as well. They're going to need a personal financial statement. They're going to need a real estate schedule. They're going to need a interim financial statement from the business you are buying. That is a year-to-date P&L and balance sheet with matching accounts receivables and accounts payables broken 60, 30, 60, 90. That is what I tell everybody we need in the beginning, at least to vet the deal. Is it something that's worthwhile to move forward or not? Now, the tax returns itself is what the deal is going to be based on, or the financing is going to be based on. People come to me and say, well, I have a deal that in 2024 and 2023, they're showing negative or break even. 25, it grew tremendously. I'd like to buy this business. My first question is always, why in God's name would you buy this business? For what? How do you know that it's not an anomaly? If you go back, just if I could segue into a story for a moment, I had a client who bought a business, when was it? Going back 5 years ago now, 6 years ago. It was in the trucking space, and he sat in the business for 6 months just to watch it and see what it actually produces because of that exact reason. Let's say we're looking at it today in 2023 and 2024, it wasn't really making any money, but in 2025 it was. And he was going to wait till the end of 25 where the seller would file a proper tax return and then get the financing. We did that. We waited till 2025 was finished. And then again, this example where anybody watching say, we know that 2025 didn't finish yet, but we waited for 2025 to finish and we got him the financing. It was a $4.3 million acquisition. Turns out the seller was scamming him completely. Had a side business that he started. He had the mindset that he was going to start another business, and that business would funnel in the business during the year of 2025 to make the numbers better. As soon as he sold it, the seller took back his business and went to his other company. They had a non-compete, so they're still in court. Talking about 5 years later, they're still in court. But that was total fraud. So don't get excited over 1 year of good financials. Anybody out there looking to buy a business, you want to see consistent growth year over year. It doesn't matter if it went from $100,000 of seller's discretionary earning. I think that's what you call it. We call it free cash flow. The seller's discretionary earnings, and then it went to $300,000, and then it went to $400,000. That's good, nice, and steady. Went from $100,000 to $800,000. Begs the question, what happened here? And it could be it's completely legitimate, but that's 1 year. How do you know it's not an anomaly?
Yeah, that's 8,000% or 800% growth. That's crazy. From year one, 0 to 1, from 100K to 800K, and then year 2, 800K, it's not going to likely keep the same trajectory to 0.6 million, is it? It's easy.
Well, I always tell people, and you see it, we deal with a lot of businesses, both in non-business acquisition, but in regular companies existing companies that are looking for inventory financing or partner buyout, or maybe looking to buy a warehouse for themselves. And you see their tax returns. I'm not going to say it's easy, right? But it's relatively easy to take a business to $1 million of profit, double that to $2 million, double that to $4 million. But once you hit the $5 million, $10 million range, it gets a lot harder to double. And if you're coming in on that train, where do you want to be? At the $400,000 range or the $2 million range? It's very nice to find a business that has self discretionary earnings of $2 million. But how much further can you push that? Every buyer thinks they're the biggest genius in the world. The seller doesn't know what they're doing. Seller is burnt out. I'm going to take this business to the next level. And some of them do, but a lot of them don't.
Yeah, I agree. We have to be very, very careful of the type of business we buy, based on the risk and then also the possible growth for the new owner. What are some of the misconceptions that people come to you with and I want to buy a business? and I want to use SBA, financing.
Sure.
What are the things that they just don't understand, or they may not be ready for, or they're hurdles that they have to jump over and they weren't expecting them?
Sure. Well, first of all, it's about the tax returns. I need the tax returns from the seller. I can't just give you the financial statements. No, we can't, because I don't know how it is in Indonesia or Australia, where you're originally from. A lot of people don't necessarily report what they make on their tax returns. So
it's the same everywhere in the world.
It's the same everywhere in the world. Okay, good to know. You learn new things every day, no matter how old you are. So the seller could show you financials, and you can believe it. I always give an example. If you own a grocery store and you're trying to do a roll-up, you're trying to expand your business now, buy another existing grocery store. You could sit in that grocery store for 2-3 weeks and you'll know exactly what the potential is. However, if you're not in the grocery store business, you don't know what the company is capable of doing other than what's on their tax returns. And the tax returns are the least amount that someone's going to show. So the financials always look better. And you can see that from an existing business. If you own an existing business, when you prepare your financial statement, for some reason, it's always better than your tax return. The main misconception I would say people make is they come and say, how do I get a loan from SBA? I want an SBA loan. SBA does not lend out $1. And especially during COVID, this misconception blew up because you had PPP loans, which was never in existence, was especially tailored for COVID pandemic. And you had the EIDL loans. The EIDL loans, I'd say, causes a lot of problems for me and for people who think they know SBA, because they think the SBA is a 30-year term. It's not. They think that SBA rate is cheaper. It's not. So the common misconception is SBA lends you money. SBA doesn't lend you money. A bank lends you money. You have to go through a bank. A bank vets your deal, decides if they want to do it, aka be the sponsor. Once they approve your deal internally, following the SBA rules, they send it off to SBA for what's called authorization. Some banks have the power to internally approve that, and it's called PLP. That the reason why you want to use a bank that has PLP or PLP status is because it's exactly. Oh, you did your homework. So you know.
I buy businesses using SBA all the time for my clients.
Great.
Yeah.
Okay.
I understand that it's good to get an expert like yourself on to really pinpoint some of the things that I don't mention.
Sure. So in continuance, the SBA gives the bank a guarantee that 75% of the loan that they lend you, they will pay the bank back. And that's the only time they put out money if the client defaults. So on $1 million transaction, $1 million loan, I should say, SBA is guaranteeing $750,000. And that's what's incentivizing the bank to lend you this money. Now, in that same misconception is they think that SBA is 3.75%. So if you use businesses SBA, if you buy businesses all the time, it is far from that. It's going to range anywhere from 1% above prime to 3% above prime. That was also one of the changes that happened. That was in the last SOP. They changed it to 3%, that the bank could charge 3%, but most banks still charge 2.75% above prime, which means today, if you're borrowing money from SBA, it would be about a 10.25%.
Yeah. I roughly say between 8 to 12% typically. Yeah. It's a typical range. Right.
Yeah, but that's a large.
There's so many lenders, right? There's so many lenders there's thousands of lenders that can be backed by the SBA.
Right.
That people don't understand.
Yeah, there are some lenders that will go as low as 1% above prime, which would be 8.5% today. They could go even at prime. But in that scenario, you're typically not putting down 10%. You're putting down a lot more, anywhere from 15 to 25%. You have great financials yourself, and it's probably in a roll-up situation where you have an existing business and you're just buying out a competitor as opposed to you buying your first business. The financials of that company is rock solid. And third, which this is something I wouldn't say is a misconception, people aren't aware of this, SBA requires that you put up collateral if collateral is available once you're borrowing more than $350,000. As a $1 million example, if you're borrowing $1 million, SBA turns around to you and say, Jaryd, do you own a house? Do you own an investment property? Oh, you own a house? How much is your house worth? If your house is worth $1 million, I want it as collateral, and I'm going to put $1 million lien against it, just like a mortgage.
Yeah.
Maybe you have a first position already. Maybe you have a mortgage for $600,000. No problem. They'll take the $400,000 that's remaining and put it on top of your head. They're still willing to give you that $1 million. They're still willing to give you $5 million, which leads me to my next misconception is everybody thinks, SBA goes up to $5 million I could get $5 million. Let me go out and buy a $5 million business. You have to remember, it's the banks that are lending you money. So how comfortable does a bank feel? Whether it's somebody who just came out of college, somebody who is a employee and looking to go out on his own and buy a competitor, or even buy the business itself for $5 million with zero collateral. You've never run a business before. How confident is that bank? Right? It doesn't happen. It won't happen. I could tell you in my career, I've done it twice. It wasn't for a business acquisition. It was for an existing business that was looking for inventory or debt refinance, and they just didn't own any collateral, but their financials were stellar. We're talking about companies that did over $50 million, one very close to $100 million in sales, and their profit was north of $3 million.
Yeah, which is great collateral itself for a lender. Now, we're talking about interest rates and terms. When buying real estate, I buy real estate in Australia, and I've seen people put bigger deposits down for loans for acquiring a business. When somebody decides, because most people want to use as much other people's money as possible and less of their own cash. So say they want to buy $1 million business. They know they can do typically 10%. Obviously, the business they need to pass, and the business needs to pass everything as well. So there's those things that are in the way to get correct first. But say, for example, somebody says, hey, look, I've probably got like 200 or 300K, and I still want to buy $1 million business and maybe get $700K loan, $300K deposit down for the business, $700K loan from one of the lenders backed by SBA. You then go away and shop around and typically find a better interest rate because of the higher deposit, better terms typically. Yeah. This is the thing that people should understand, right? Is like, yes, you can buy it for 10% down, but if you have a little bit more money, typically you can get better terms and it's easier to get approved, right?
So my answer to that is yes, right? That is exactly what we said before. If you're going to put down more money, if a bank is going to give you a better interest rate, it's going to be a few banks though, just because there's still, I'm going to say a handful or two handfuls of banks that would want to lower the rate because they are going after the 10.25%, the 2.75% above prime. Right? They need this to help their balance sheet. It depends also on what type of business you're buying. For that $200,000, it's not that much more in payments. If you're buying an inventory-based business, you need as much cash as you possibly can. That's where your bread and butter is. If you're buying a service business, then I'd say, yes, it makes more sense to put down that capital. I'll tell you a little secret on how to get 100% financing. If you're buying a business for $1 million, you have to put down at least 10%. And that's another thing that people should know. SBA allows you to get 90% financing. It does not mean the bank you're going to go to is willing to give 90% financing. There's many banks that I deal with that wouldn't touch anything that is more than 80% financing. They're just not going to do it. And they prefer you be at 75%. Now, going to my example, if you're buying a business for $1 million and you only had to put down 10%, so you put down $100,000. So we now have a $900,000 loan for the business acquisition. And then on top of that, we can ask for $150,000, $200,000 of working capital.
Yeah.
So the loan amount would be $1.1 million. You put in $100,000, but you're getting back 1.1.
Yeah. Yeah. And then there's also other strategies, right, where you can, as a part of your deposit, you can have your legal fees. Like if you've got a receipt for some of your legal fees, you can put up, say your legal costs are $20K and you've got a $100K deposit. You could take, if you've got a receipt, in some instances, you can take off $20K off that deposit and put in $80K, which totals $100K. What instances can you do this, and what is it just dependent on the lender?
So it's going to depend on the lender giving you the loan amount. What you just described is exactly what I described, just you're using different templates to describe it. Whatever that $20K that they're giving you is in working capital. Because the SBA is so versatile, it's the chameleon of SBA financing. They're able to give you working capital. They're able to give you inventory. They're able to refinance debt. They're able to buy a part. There's so many things that you can do with it. So working capital or bills, closing costs. Remember, SBA has a guarantee fee. People aren't aware of that. And $1 million is going to cost you close to 3% to actually, that you're paying the SBA for that guarantee of 75%. That is going to get rolled up into your loan. So what you typically do is take total project costs and you'll put in 10% in that. So if your legal fees are $50,000, I'll say my project cost is $1,050,000. Right? If you have another expense, I don't know, maybe you did environmental, you did an appraisal. If you're buying a property, with the business. Many times, at least in my world, people come over, and I don't know if you've had the opportunity with the businesses you've bought. Sometimes you have a business and a piece of property that's being sold at the same time.
Yeah.
And that's what I call is the jackpot, because then you could potentially get a 25-year amortization as opposed to a 10-year. Let's just remind the audience, I don't know if we spoke about it before, SBA is a 10-year program. So you get the money today, and it's just like a mortgage, and it's amortized over 10 years. If you're buying property, it's amortized over 25 years. So if you're buying a business, let's just say for $5 million, but $3 million, more than 50% of the use of funds are going towards property, you can now amortize the entire loan into a 25-year amortization, which brings down your payment significantly.
Yeah, so it's absolutely fascinating. It's like, so when you buy a business, say we're buying an e-commerce business, right? I help people buy online businesses, and a portion of that business it's got a warehouse and they're renting the warehouse. Obviously, if they renting the warehouse, they can't do that. But if they owned the warehouse, that business, and they sold the warehouse and the distribution, so the business is the distribution of the sales from that warehouse, then you could have a longer term period.
Yeah.
So yeah. I mean, yeah. What are the terms like that? The interest rate, is it different?
It is different. It would be cheaper.
And how significant?
So it could be significant. I'd say between a half a point to sometimes 2 points. So
wow.
It could be like an average of 10.25%. You're going to be somewhere at 9 or maybe even 8.5%. Again, it depends on how strong the deal is. At the very minimum, you'll be at 9.75, which would be at the very least, it'll be a half a point difference.
And would that be still no prepayment penalties?
No. So it's a good question. At a 25-year loan, there's a 3-year prepayment penalty.
Okay.
So year 1, it's 5%. Year 2, it's 3%. Mm-hmm. And year 3, did I say year 3 or 3? Year 1 is 5%. Year 2 is 3%. Year 3 is 1%. And then you have no more prepayment penalties.
Right. And with a regular SBA without property, a 10-year amortization.
10-year, there is no prepayment penalty. It doesn't matter what your use of funds were for. As long as it's not for property, you don't have any prepayment penalty.
Yeah, cool. Now, seller notes. I know that SBA can be a bit wary about seller notes, and it can change things with SBA. And I know that there's some certain things that you can do outside of SBA, like come to your own note agreements or seller financing agreements. What are some of the structures that you've used with seller financing or seller notes to either get around SBA or to do it through SBA?
So ultimately, you're not going to get around SBA very much, right? Unless you have a purely side agreement I don't know about, and the SBA doesn't know about, and you trust the seller, or rather the seller is going to trust you. And that's going to, again, be in a situation where it's a friendly transaction. It could be a family member that's buying it. It could be an employee that had longevity in the company. The seller is looking to retire. They have a relationship. Because otherwise, why would he trust you that you're going to pay him back? Let's remember, when you come to SBA, so ultimately what they would do is lower the purchase price. If he was selling it for $3 million, if the seller was selling it for $3 million, you say, okay, how much of a note is he willing to give you? If it's going to be $500,000 or $1 million, you put that on the side. And now you just have to come up with less of a down payment. If he's willing to wait 10 years, God bless him and God bless you for finding that seller. Seller's note is not a problem as long as it meets the necessary cash flow. So in the business buying world, everybody talks about seller's discretionary earning, right? Yep. We look at it, what is the free cash flow? And the way I describe it to everybody is you're buying a business. Why does anyone buy a business? It's to support themselves and their family. How much money do you need to support yourself? Everybody has a different number, right? Mm-hmm. Take you as an example, you said you buy properties. Well, are all the properties income producing, or some of them still in construction? Maybe some of them are rehabs, and you're paying a mortgage on that is going to take away money from you. That money has to come from somewhere. If you have children, if you're married, it costs you more than somebody who is not married. If you have high credit card bills, what's your average monthly payment? It differs from each individual. So we have to first establish and figure out how much money does that specific individual need to live.
Yeah.
And the business that they want to buy should provide them with that type of living times 1.25%, a 1.25 debt service coverage ratio.
Debt service coverage ratio, yes, yes.
And then after that, how much is left over in the business to support the loan request that we're making. If both of those are met, that's great. Those are met, and the seller is willing to give you financing. Hold a note. Well, what is the seller's terms? Is there enough cash flow to survive?
Yeah.
If the answer is yes, we have a deal. If it isn't, then you have a problem. And if you believe, many times I was working on a deal. It wasn't SBA. It was a $21 million transaction, so it was much larger than an SBA can actually fund. The seller was willing to hold a note for close to $18 million.
Whoa.
You say, whoa,
For
why
how
is
long?
that? For 10 years.
Whoa.
Just like the SBA, yes. Now,
And was it a finance, like interest on the note, or?
yes.
Okay.
If I told you the interest rate was 6%.
Whoa.
Yes.
Wow.
Yeah. And if he was going to hold a note originally they were structuring the deal where he was going to get about $11 million of financing and put in $4 or $5 million, and the seller would only hold a note of about $6-7 million. He was willing to give it to him at 4%, but a 5-year balloon. 10-year amortization, 5-year balloon. But why was the seller willing to do that? Is because he believes in his business.
Yeah.
And he believes that he's burnt out. He has his business for 30, 35 years. And he believes that he's reached the peak, that as far as he can go, he's tired of the business. And this young gentleman who is looking to buy it is really aggressive and will take it to the next level. And he believed that. Yeah. So he believed that they had some sort of earnout on top of the $21 million. And he believed he's going to do it. So therefore, he's willing to give $18 million. I believe in this company. That's a statement that someone's making.
So did he buy I agree. Like he believes what he built will last 10 years with this new owner.
Not only will last, sorry to interrupt you, not only will last, there's so much more growth that could be done, right? They were working 5 days a week. He could bring this up to 7 days a week. They were doing, I think it was 13-hour shifts. He could run this 24/7. They don't have one salesperson on staff. They're doing $30 million in sales. He does not have one salesperson on staff. Not only that, the orders either come in through email, but most of them are still through fax. So you can imagine how old the clients are.
Yeah.
And this is going back to about 6 months ago. So there's so much innovation that can be added to this business, and the seller knows it. He's just tired. He's making a few $1 million, almost $5 million every year, which is another thing we should speak about. He was buying it for a multiple of above 4, between 4 and 5. In the SBA world, and I see this a lot of times in the insurance world, where I don't know if you're familiar with P&I insurance, but in the insurance world, they trade at multiples of 10, 12. It's crazy.
Yeah.
When you're buying an Amazon business or an e-commerce business or a regular business, exactly right. And if it's more than 4, I could tell you on a handful of times where I've done more than 4 multiple, because the cash flow just doesn't work. It's not possible, and the business valuation wouldn't come back.
Yeah, no, I agree. This is the thing with my clients now is like, we're obviously buying based on EBITDA. So what the EBITDA needs to match their income they need to live, plus the debt servicing, and then a little bit on top for growth of the business once they take over it. And the bigger the multiple is, so if somebody wants to go for a software business, the harder it is to do that with a software business, because the financing is not going to work.
Exactly. Unless they're putting down a lot more money. You're going to put down 40, 50%.
Yeah. I just want to give people an example there so they understand, is like with a business that's doing $1 million EBITDA income, right? And then the business is, say, it's a $2 million business, say $2.5 million business, and it's it's an Amazon business, and they are financing, say, they've got a deposit for like $250K, right? So they're financing the rest, which is 90% down. So they've got a lot of finance there, but they've got a lot of income. They've got $1 million of income per year to be able to pay for their family's bills, their lifestyle, and then also pay their debt servicing, have money on top. Now, if you go to a $3 million software business, that's at a multiple of, say, 6. It's making a multiple of...
You could use use the same example of $1 million, right? And they're asking for a multiple of 6. It would be 6 million.
Correct. Yeah, correct. So it's a $6 million software business, and you got $1 million in income. You're typically not going to have that income that you need for the family plus the amount for the debt servicing.
Right. A good rule of thumb I always tell people is for every $200,000 roughly, and it depends where the rates are, which is another thing we should point out, an SBA rate is typically a floating rate. Some banks will fix it. Again, those are the creme de la creme deals. But most banks are going to be at a floating rate. So if rates go up, if prime moves, your rate goes up with it. If prime goes down, your rate goes down with it. So depending on how high it was, and going back a year and a half ago, when the rates were close to 12 and a half, it was expensive.
Yeah.
My example wouldn't work, but for the most part, every $200,000 of seller's discretionary earnings, or EBITDA, or free cash flow as I call it, would cover $1 million of financing. So $1 million of net income would cover a $5 million loan. And you have a bit of a cushion there, because as the numbers get larger, you have that discretionary of the 1.25%. And the 1.25% is a standard that I set. From the SBA perspective, it could be a 1.15 debt service coverage ratio. And if the bank wants, it could be even a 1-to-1. They just don't do it. That doesn't happen. Now, if it's a solid company that you have year over year, imagine over an average of 3 years, you have a 1.2 or 1.15 debt service coverage ratio of a solid company. And in some cases, there's one example recently. I went back 5 years before that just to show the consistency of it. They don't need it for their file, but I just wanted to show it. And they were willing to accept a 1.1, I think it was a 1.18. It was close to 1.2 debt service coverage ratio.
Yeah.
People look at projection-based deals. I don't know if you want to talk about that or not. They don't happen. Okay, they don't happen. I shouldn't say they don't happen.
Well, it's highly unlikely they're going to happen. And I don't typically tell people or help people acquire businesses based on revenue alone and based on growth optimization.
Right.
The same reason the banks don't lend to them.
Yeah.
The risk is so much higher.
It's the bank that we have to go to. SBA allows for it, but will the bank accept it? And 9 out of 10 times, I'll say 10 out of 11 times, they're not going to accept it, right? Yeah. A projection-based deal that gets done, or if you hear people getting startup deals done, it's typically not your average startup. It's probably, like we said before, a grocery store. Somebody owns 3 grocery stores, and he's buying a grocery store that's failing, but his projections are that he's going to turn it around, put money behind that person. And if it doesn't work out, this new location doesn't work out, I have 3 companies that are backing it. So in that scenario, while it's projection-based, it's really not.
Yeah, absolutely. Talking about online businesses, that's our main topic of discussion here on the pod.
Is that Amazon?
The Amazon business is one type of e-commerce business. There's multiple different types of e-commerce businesses, right? You've got e-com brands, you've got sell product distribution, you've got drop shipping, then you've also got EPL, and then you've got Amazon FBA. This is many types of e-commerce businesses. But I want to ask you, from the online businesses or people acquiring online businesses that you serve, what are the typical types of businesses that you're helping people purchase with SBA?
So in the categories that you just mentioned, from e-commerce world, the number one would be a Amazon company, whether it's FBA or not, and 3PLs, I'd say, are the top 2. We have... Yeah.
What percentage would be Amazon?
What percentage would be Amazon?
Whether it's FBA or not?
From business acquisitions, I'd say it's maybe 20% in everything, not just for e-commerce.
Okay.
All of our business acquisitions, maybe 20 to 30%. If I'm looking at it from an e-commerce perspective, probably looking at 60 to 70%. But the larger transactions are the 3PLs.
That's right, because they don't want to be tied to Amazon.
Yeah, and they're typically buying real estate. So, we just did a 3PL deal we closed in January. That was for 13 point something million dollars. I don't remember offhand, in Pennsylvania. And they already had a transaction a couple of years back in Las Vegas. So, and now he just called us. He has a third transaction that he wants to do. So 3PLs seem to be more, I'd say, stable than because remember, you don't have to do well on Amazon to be the 3PL. You just need your clients to do well. If they don't do well, you have the inventory. And if not, there's always somebody behind them who thinks they're going to do better and pop up, I need the storage space.
So are you saying this client of yours, he owns a 3PL warehouse and then he's now acquiring e-commerce brands that he can roll into using that 3PL service?
No, this particular client has 2 3PL businesses, one in Las Vegas and one in Pennsylvania at the moment, and looking at another one in New Jersey. He only services, I shouldn't say that. He has another side business which he services also to Amazon sellers, where he sells boxes. So it's another side business, which is a great business, especially if you have Amazon customers at your fingertips.
Or 3PL. services too.
Yeah, and exactly, all 3PL services, and it doesn't have to be 3PL. Every grocery store, every warehouse, every wholesaler needs boxes. So he's looking to acquire his third location right now. He only services the Amazon sellers and brand sellers and dropship sellers. They'll have some dropship companies that actually use him as a hub because they have different, but just like Amazon does. Amazon's not the only e-commerce platform that has hubs. You're an Amazon seller, you need a place to store it. You may need it in Vegas. You may need a service to West Coast. You want to be on the East Coast. He has a service for you. If you want to be in the Midwest, he doesn't have that yet, but maybe he has a friend he could refer you to. He stores it for you. Some clients, he does the full service where he actually picks and packs it, ships it out. And then some of them, it's send a pallet, send 3 boxes to Amazon fulfillment centers just so they could have the prime status. But I believe he has prime status as well.
Yeah, cool. It's a really good way to build out a holding company. I think about it through somebody that owns maybe an e-commerce brand. They're buying out the digital marketing agency, and then they're buying out the 3PL, and then they can just plug more e-commerce brands into that use the same digital marketing agency and the same 3PL, and you own those. And it's really
then you have your own ecosystem, your own environment.
Yeah, exactly. And so talk to me about how much easier it gets to acquire once you've already got an established business that can run parallel or merge into the business you're acquiring, like using that primary business you purchase as an SPV. For somebody that owns a e-commerce business already, like what's the next step to acquire another one using financing? Does it get easier? And if so, how?
It's definitely easier for somebody who already has an existing business and is looking to buy out a competitor, right? Why is that? For 2 reasons. One, there's a lot of cost in the business that you are going to eliminate. Administrative costs, maybe rent if you don't need their warehouse, if you don't need their office space, like you have your own office space already. 3, you have profit. Well, hopefully you have profit, right? If you don't have profit, then you should not be buying another business because you haven't proven that you're capable of running.
It's already leaking, yeah.
You can't. You haven't proven you could hold the bucket, right? So if you have profit now, if the business you want to buy, let's just take a unicorn example. It's the perfect business that aligns with you. You maybe you manufacture your own product line of shoes and sunglasses, and this is your competitor who also does it. You notice hicks in his armor that they're not selling through proper channels, whatever it is. It's a great opportunity. You may want to pay 4 or 5 multiple for that company. Again, the cash flow doesn't typically support a multiple of 5. Now you have an existing business. You could piggyback on the profit of your existing business to support that other debt.
Right.
So it's it's easier. You have a more discretionary more discretionary income that you can actually apply towards the other business if it's not capable.
Yeah, which is really cool because then you can start buying safer and safer businesses.
Yeah.
Businesses with a higher multiple that have less risk. And that's typically what you want to do as you grow. From what I've learned and what I teach is that if you want to increase your wealth, you need concentration. If you want to preserve your wealth, you need diversification. And if you are growing, then you typically don't want to just keep growing at a crazy accelerated rate at the risk of having high risk businesses. Right. You can buy lower risk businesses and diversify that income throughout multiple businesses and piggyback off that one that's doing really, really well.
Another problem that we find a lot, and I see people even post-closing, after I've given them a loan, a business doubles again. You get to that $10 million and you think you're, Donald Trump. You think you're God, or God should call you for some question.
Yeah.
And you thank God you're doing well, and you prepare for the future, and then you plateau, and then you have a tsunami of expenses that are coming behind you that you don't have what to feed it, but you don't have the space to feed it. You don't have the financial capability of paying all these employees that you hired because you thought you're going to go from $10 million to $20 million this next year. So slow and steady, or you could jog a little bit. I don't have a problem with that. If you run, you got to bootstrap it, in my opinion. Yeah. I've seen those companies that run, they bootstrap it. The seller is sitting in the warehouse late at night, literally packing orders till 11, 12 o'clock at night, coming in at 6 in the morning, bootstrapping. Everybody is doing more and more. It's more of a family environment. When I say family environment, it doesn't mean they're actually family, but the employees are happy to be there and they feel like they're part of the team. In that scenario, when they run, they are very successful.
Yeah, absolutely. Yankie, thanks so much for coming on. Really appreciate you
My
sharing everything
pleasure.
you know. Yeah, I know there's more in there and we might need to get you
Yeah,
back.
we could talk for hours, man.
Absolutely. Absolutely. Where can we send people to check out more about how you help people?
Sure. My website is sbaloangroup.com. You could reach us at 484-722-5626, which is 484 SBA.
Oh, amazing. Cool. Remember that, guys. Reach out. There'll be a link in the show notes as well. So thanks again, Yankie, and everybody who's listening. Cheers. I'll see you in the next one.
My pleasure.